identifying promising opportunities and focusing on lower risk. I mean, that's what we're always about because capital preservation is key. We really focus on that. We haven't lost a penny of investor money to date, and we don't plan on losing any investor money. And now actually, in fact, is one of the best times to invest. It's when people are fearful that you find opportunity. And that's what we're seeing.
Welcome, everybody, to the newest episode. I'm your host, Nathan Loy, Viking Capital's Director of Strategic Planning and Senior Analyst. Today, I have the privilege of being joined with us by none other than Ravi Gupta, the fearless co-founder and COO of Viking Capital. Ravi, welcome.
Thanks, Nathan. As always, happy to be here.
Always. Ravi, you've navigated real estate, for over 2 decades. You built a really impressive track record with acquisitions, asset management, dispositions, and you really kind of found an appetite for risk-adjusted deals kind of throughout Viking's history. So I'm really excited to dive in today and really explore what made Viking, what it is today and kind of unpack the journey along the way. So for the audience, if you want to, up your real estate game, you won't find insider knowledge that's more valuable than today's episode. So get ready to really immerse yourself in the world of syndication and doing kind of Viking style. So with that, let's start off. Ravi, what is Viking Capital's strategy for identifying promising real estate opportunities, and how do you really focus on lower risk deals with some sort of value add potential?
Happy to answer that question, Nathan. And just a comment on your beautiful introduction. It's always nice that you change it up every time we talk, which is quite often. But I like how you introduce me. 2 decades of real estate experience. I started investing when I was 25, and I purchased a condo and rented a room. So that's like, those are 3 years of real estate was having a roommate in a condo while I was doing my residency at UNC, which was important. All these experiences are important to have. They stack on each other. We started Viking Capital in 2015, so it really started taking off in the past 8 years. But to answer your question about identifying promising opportunities and focusing on lower risk, I mean, that's what we're always about because capital preservation is key. We really focus on that. We haven't lost a penny of investor money to date, and we don't plan on losing any investor money. And now actually, in fact, is one of the best times to invest. It's when people are fearful that you find opportunity. And that's what we're seeing. In fact, we closed on one deal recently. That was a phenomenal opportunity. Very low cost basis, and we're about to close on another one, same type of thing. And the way we've found these particular opportunities, number one is focusing on our experience. I mean, that's key, and that is so important because the brokers know that. They know that we've transacted on 20 plus assets. We've raised a significant amount of investor capital. We've never not closed on a deal because of issues with capital or any other reasons. So the brokers know that. And we've in fact been picked over several other sponsors that actually bid at a higher price than us because of our experience, especially in this climate where money is maybe more difficult to come by for many folks. I mean, for everyone, they're a little more hesitant to open up their pocketbooks to invest. We have success with our investors because of our experience and our history of how we performed, and we've created that relationship. So the brokers know that we're going to close. The sponsors know we're going to close. We have the experience to do so. We're selected, even though our price point, our strike price is less than the competition. We still get access to some of these deals. So we look at certain select growth markets. Really, we want to focus on markets where there's a lot of job opportunity. There's continuing growth. Even with the kind of economic shift here, you're still seeing rents going up. That's still happening in certain markets. In certain markets, it's not. So we're really focused on those. We're looking at newer vintage assets with value add potential. We recently closed on a deal, Park 33. That's a 2018 vintage property, but it's 5 years old now, which is not that old, but we have found that if we make a few changes, not a whole lot of value added or money added to the apartment complex, the rent can bump a significant amount, and it makes a lot of sense. So those are the types of deals that we're looking at. Less deferred maintenance, just obviously newer, more sturdy deal. And then the final thing is we're really looking to focus on optimizing debt. As we realized during the pandemic, when prices were escalating so quickly, variable rate debt it works in some ways because it's much higher leverage, but it doesn't work in others when you're looking to refinance and there's a market shift. So we really want to focus from this point forward on optimizing debt, as low as a interest rate as we can get at the time. But if the deal works, even with a higher interest rate, it's fine. It doesn't really matter at the end, because really the cost basis is ultimately what's important. You buy something at a super low cost basis now, 5 years, cap rates start going down, cost basis goes up, even with a little bit higher interest rate debt. We're still able to make a phenomenal return on that deal.
And it's important to note that it's especially, in this environment, there's always going to be some sort of risk with the investment, right? But what I think Ravi really pointed on really well was that the fact that it's risk adjusted, where, there are some deals like new construction or opportunistic deals where they have, really high returns, but there's also tremendously high risk. And on the opposite end, you have kind of more core, stabilized, much newer assets that don't have as much risk, but you don't kind of have those same returns. So we kind of found that balance right in the middle, where we're targeting risk-adjusted deals that have some sort of value at upside to really kind of play that arbitrage and really kind of take the benefits from both ends. So, Ravi, can you outline, Viking's ideal target size for multifamily transactions and potentially how that's kind of shifted throughout your journey since, when you first started to where we are today?
Absolutely. So when we first started, we were looking at smaller deals, maybe, 100 plus units. 100 is the minimum. That's where you really start gaining that the incentive and price reduction per unit for insurance, for payroll and other types of expenses. So that's the minimum amount, and you can really justify having a property manager on site with 100 units. So we're looking at a 100 unit minimum. We're looking at a pretty low target transaction of like $5 to $10 million. We're looking at C-class properties. We've evolved since then, really looking now at I'll start. Previously, we're looking at like $50 to $100 million range in A and B class properties, but what we're realizing now in this market is a smaller size acquisitions, lower cost acquisition may make more sense. So we're looking closer to the $25 to $50 million price range. Still A, B class assets. We're looking at the standard types of things and maintaining an occupancy of 90 plus, growth markets, as I mentioned before, a certain cash on cash return really focused on. We want to make sure the property, even with potentially a negative debt leverage, because what that means is the cap rate is less than the debt that we get. We still want to see positive cash flow. You can still see that. They don't have to be, you don't have to have positive leverage, meaning the cap rate the cap rate doesn't have to be lower than the interest rate, the debt interest rate to get cash flow. You can still see it the other way around, and that's what we're focused on as well. And then we're focused on the value add business plan where we can continue to add value. And then as we add value, the cap rate of the asset over time just increases and increases.
Yep. And that's important to know too, is there can be deals that have great cash flow, but what we really try to focus on is a cash on cash return. So not only is, what is the cash flow the property, is spitting out or is producing, but how is that relative to the cash that we invested initially in the project with, the acquisitions costs and our renovation costs. And so that cash on cash that we're focused on. And we're seeing that a lot too in kind of, the private sector with our kind of, private equity firms and syndications, but we're also seeing it on kind of the larger scale institutional side of things too, where these large institutions chose to, especially in kind of the, the unprecedented climate that we're in now, come down and start to take down smaller deals and potentially even purchase them all cash and then refinance out in, 3 to 5 years once kind of that debt market has stabilized. While, the leverage still makes a lot of sense, but there are some players that are choosing to purchase all cash have a little bit of a lower cash on cash initially, but then, hopefully transact and refinance in a few years and then pull some of that cash out. So with that, Ravi, we went over kind of the typical side of deals. What's our typical hold period? How long are we typically, holding the assets for? And are there certain things that we're doing during, the beginning phases, the middle phases, and kind of the last phases during the investment?
Sure. So in the past, we were holding for shorter periods of time because we saw such rapid organic growth that it made sense to sell early. And we're seeing our exit criteria being hit in 2-3 years. So it made a lot of sense. Currently, we're underwriting at a 5-year hold. Now, we may sell earlier if it makes sense to. We may hold it for a little bit longer if it makes sense to. But that 5-year period is about right, where we can implement our business plan, we can increase the value, and we can sell when that value is fully implemented in the property, and it's just sort of coasting at that point. It's reaching its highest potential, and then the next person buys it as their value add and increases value in some other way. So that's the hold period. As I mentioned, I've said this several times, but adding value is extremely important during this period, and you really want to implement that business plan quickly and efficiently. In fact, you really want to finish everything by 18 to 24 months. And we've noticed that in some of our assets where we have not finished our business plan purposefully in some cases. I won't get into those reasons during this podcast, but there was purpose in not finishing them, and others where we just pushed through and made a very rapid push to finish everything. And we noticed that the ones where we completely finished the business plan quickly almost always performed exceedingly well, much better than the ones where we try to take our time and sort of be more diligent about things. Sometimes you just want to push through. So that's in essence what our strategy is.
Yep. Especially for those shorter hold periods too, right? Whether it's 5 years or 6 years, when you're right around that time frame, you don't have kind of the leniency of, holding it for 7-10 years. You really do need to drive value in those first 2 years. You might drop occupancy slightly, but you're renovating units, you're getting premiums, you're driving NOI. That really sets you up for success if you choose to, refinance, or if you go to sell, especially on the debt side of things too, right? Because a lot of the kind of national debt firms like to see stabilized occupancy for at least 3 to 6 months. So you're actually setting up the future buyer in a good position to buy stabilizing the property in kind of those final year or two of your business plan. So, Ravi, we've kind of touched on the current economic climate. Can you kind of give us a 30,000 foot view of what's going on in the economy currently, and then what challenges have we faced at Viking, but also kind of on a broader scope across the multifamily sector?
Yeah, absolutely. So, stepping back, as we all know, we are, there's economic change happening. Interest rates are going up. Inflation's going up. It's at this point, it's relatively has stabilized actually on the downtrend. We're seeing low transactions. We are having, there's a lot of dry powder, meaning a lot of people have money to invest, but there are not a lot of deals out there to invest in. We're still seeing certain sponsors that want to sell, but they don't want to sell at any price. They want to sell at a price that they were quoted a year ago, maybe, which is not possible anymore. So, these assets are overpriced. They're not hitting their price point, and they pull back. I mean, we did the same thing. There was an asset that we were contemplating selling because there's so much interest to buy with this low transaction climate, but people didn't hit our strike, and we decided not to sell. So this happens very often. In fact, we're also seeing, as I mentioned, declining asset values. We are the prices that were quoted previously aren't holding. Asset values are dropping 20, 25%, sometimes 30% from their peaks easily. Cap rates are going up. So this is a challenging time. Also, investors are hesitant to invest. When it feels like everything's collapsing around you, you don't want to put your money out there. You just want to hold tight. A lot of people have this mentality, but what people sometimes don't realize is now is the opportunity to buy, and this is where a lot of people make a considerable amount of money, is because when you can transact, it's on a deal that has a very low cost basis. And what that means is the price per unit is much lower than it was years ago. In fact, we're seeing the prices per unit equivalent to maybe 5 years ago in certain areas, which is crazy. And I know this is only going to go up. There's no question. Certainly when inflation is at a point where the Fed stops increasing interest rates, and we're in a period of stability. These rates, the values are going to go much higher. So, they're challenges, but they're opportunities. So what we see is a lot of opportunity as well, and that's where we're trying to just continue to transact.
Yep. And that speaks to kind of the double-sided nature of valuations and how properties are valued, especially in the multifamily space, right? You have, on one end, you have the property where you can do the whole value add plan, you can make it cash flowing, you can optimize expenses, you can drive revenue. But the second side of that equation is the market and what's coming around with the market in terms of uncertainty and buying power and debt. And those two can sometimes come to a head, right? Where you have, even if a property, let's say, crushes it on the property level side of things and cap rates drop, eventually once cap rates start to compress again, that valuation will meet wherever it was projected, for your pro forma, right? And that's a lot easier to control, at least on the property side of things. You don't have as much control over the market. So if, you're in a situation right now, I'd heavily focus more on the operations of the property as well, knowing the market will correct itself. But we've seen unprecedented rent growth and unprecedented pricing, and that's going to naturally have to meet an equilibrium or a kind of a status quo almost until we can kind of, start the cycle over again. So that's why it's really paramount right now to focus on cash flow and to focus on good operations, knowing that the valuations really only matter when you come to refinance or when you go to sell a property.
Yeah, you're absolutely right, Nathan. I was, really focusing on opportunity in buying, but to your point, when you own an asset in this climate, that is ultimately what you're focused on is cash flow, is operations, is decreasing expenses as much as possible, increasing revenue as much as you can. Asset management is so key here. You really need to 100% focus on that to be successful. If you don't have an asset manager, and some of you that are listening may be starting your business and maybe you are the asset manager, but it's worth even hiring someone part-time, getting someone else to evaluate your deals. Hire a fractional CFO. Fractional CFOs sometimes have that asset management, at least some of the asset management experience. They can provide a nice financial overview, but they can look at your finances and see where there is opportunity. So yes, paramount. That's very important. Good point.
Yeah, absolutely. So given the obstacles, of high interest rates and overpriced assets, what creative strategies, is Viking employing currently to really push deals across the finish line, to stay in the market and really kind of, analyze what's going on despite, the fear and some of the uncertainty that's around?
Yes. So for one, we are underwriting and throwing out LOIs constantly. So there are assets where the sponsors fixed on a price, and regardless of that price, we're throwing out what we think it's worth. Sometimes there is a delta of 10, 15%, and some sponsors may not like it. Some may find that offensive, but that's where we think the price is. Now, what we've noticed is as we're throwing out these LOIs, initially it was like that 15% range, then it started getting to be 10%, then the difference started becoming 5%. So we're getting to the point where we're getting that inflection point where we will transact on more assets soon. But that's how you stay in the game, is you consistently, you're out there, you analyze the market, you're throwing out LOIs. Some operators are sitting back and have their pencils down, not underwriting, not looking at anything. When they get back into it, they're not really going to know where to start. And because we continue to underwrite, we know where we are currently, we know where we need to go. And that's a huge opportunity because of there's going to be a period of time, maybe a 6-8 month period of time where there's a ton of opportunity and we're trying to hit that. So that's one thing. That's how we tackle overpriced assets. We don't buy them because we know what the prices should be. High interest rates, if a deal makes sense with a high interest rate, then we'll do it all day long. It doesn't, I would rather buy a deal that is a low cost basis, that is cash flowing and has a 6.5% interest rate versus a deal that's super expensive. You're buying you have a 3.5% interest rate and you don't know what's going to happen in the future. So I'm talking about two different, market cycles. One was before where, we, of course, we're being conservative as much as we could in how we would purchase and what we're looking for. But many operators at that time, they were just like, hey, look, I'm hoping things will improve. I'm going to buy at a high cost. Doesn't matter. I'm getting super cheap cash in terms of debt, and I'm going to make this deal work. Well, a lot of those people found out that formula doesn't work, versus now where you can buy things at a higher interest rate, but the cost is very low. So I'd much rather buy properties now than back then. So those are our thought processes. Those are the things we're thinking about. We're also using or trying to utilize some creative strategies like assuming a loan. So if somebody got a loan at a 3% interest rate in the past, we will assume that and not get new debt. So that really helps tremendously there. We're looking at different types of preferred equity type structures. We're looking at other types of creative financing structures. Sometimes we're even looking at bridge to bridge structures, things of that sort. But most commonly, new acquisitions, agency debt, that's Fannie Freddie debt, fixed, stable, and 5-year hold.
Yep. Now I'll kind of speak to that on the acquisition side of things too. We're putting in numerous LOIs, just kind of stay in the mix and kind of get a pulse in the market. And I've seen multiple deals that are lender forced sales, or the broker telling me that they're gonna have to sell the property at a loss, or hey, this is a really motivated seller and they're willing to meet market on pricing. So what we're seeing is those deals that are crossing the line do typically come from motivated sellers, those that really are forced to sell their kind of timelines up, if you will, and they don't really have that much optionality. So we're seeing lots of sales on those fronts, and also as Ravi pointed out, loan assumptions make a lot of sense right now, right? As rates have stayed high for at least about 12 months now, and there's no real sign of them decreasing at least for the next 12 months. Those interest rates make a lot of sense when you're assuming them when market rates are 2% potentially higher than the assumable loan, even if it takes a little bit longer to close. And then on the second front, those deals that are transacting closer to guidance tend to be those kind of newer assets that might have some sort of core plus kind of value add strategy to them, where people are choosing to go for kind of less riskier assets, given the potential pain they felt in the last 12 months, and also the uncertainty moving forward, which is kind of right in line with our strategy too, where we're trying to find good quality deals in good locations that just need some sort of uplift, whether it's interior renovations or some sort of operational play. So let's kind of recap the key takeaways from our discussion, Ravi. What are kind of the core principles that are really guiding Viking and their kind of strategy in real estate acquisitions?
Yes. So, in summary, things I take away from this conversation, number one, experience is key. You really want to find a sponsor with experience, ideally of multiple market cycles. But if not, someone with a decent amount of experience and track record to show that they have performed. And if you are starting out in your syndication journey, now is a great time to start, because there is opportunity, as I've been talking about out there. Find someone on your team or hire someone part-time that has that experience. That's so important, because that person could save you a tremendous amount of pain and money and agony, because they've been through it before. So that's number one. Number two, underwrite long-term holds. I mean, long-term as in 5-year holds is good. We're not going to see the 2-year flips happening anytime soon. Really, you want to focus on at least a 5-year hold. Cash and cash is king. make sure the deal cash flows day one, and then you only build from there. Long-term stable debt is important. We've seen what happens with short-term variable rate debt. That's not ideal. Long-term stable debt is best. And, as we discussed over and over, focus on geography, location, high population growth markets, focus on areas that are going to continue to grow and improve, and in areas that, even though there's been an economic shift, rents, you're not seeing the higher day-to-day growth of rents, but you're still seeing that growth happening, and that there's a lot of markets out there like that.
Awesome. I love it. And the last question for you, Ravi. I know nobody has a kind of a crystal ball, but where do you see kind of the most promising opportunities in the multi-sphere now for the next year or two, given kind of the broader economic uncertainty?
Yeah, I like this question. I ask everyone else this question because I don't know what's going to happen. Nobody knows what's going to happen, but you just have to pose that question to as many people as you can and then assimilate that information. And I've asked people that have gone through, like 5-6 market cycles, people that are like their 70s, approaching 80, that have been doing real estate their whole lives, and their parents have done real estate, so generational players. Like, I like asking those people this question, and basically what I've heard, and this is sort of my sentiment that compiling all that information, is that 2024 is going to be difficult. The first part of that, the first part of the year especially, they're going to be certainly, in the office space, we're going to see a lot of these sponsors handing their keys over to the lenders because it just does not make sense. You're going to start seeing multifamily deals start unraveling. That's probably going to be the case. It is a political year. It's an election year, 2024. I've heard from multiple people that in election years, things start miraculously stabilizing. And one of our advisors has said this. He said this a couple of years ago. He said, "Mark my words, 2024 November, things will be good." So, I'm hoping for that. I see that happening as interest rates start falling. The Fed isn't increasing rates, the Fed funds rate, as much anymore. I don't think there's any thought about increasing any more potentially. So we're seeing things stabilizing, and stability in the market is huge in the multifamily space, because when you're underwriting and there's variability, then you don't know what's going to happen in a month or two. Then you're just done. But or some people are done. But if you know that, look, interest rates are going to stay stable for a while and probably going to go down shortly thereafter, you can start underwriting. So you're going to see more deals done. So I'm going to say a pretty tumultuous start to 2024. I'm going to say things start stabilizing towards the end of 2024. I think this is still a year of tremendous opportunity if you understand what you're doing, and you've taken into account all those variables, and you're looking at the cost basis of the asset. I think there's a huge amount of opportunity right now. And when things start stabilizing at the end of 2024, 2025, if that does happen, that prediction does happen, that's when it may be too late to get those deals, because people have a ton of cash right now. A lot of companies, a lot of institutions, a lot of investors, it's on hold. I've heard this, I've read it over and over and over. They are just waiting to place this capital. And once things stabilize and these big institutions start underwriting again, the asset values are going to start going up again. Cap rates are going to start compressing again. Interest rates are going to come down. I mean, this is going to happen. We know it's going to happen. This is a standard boom bust cycle. It always happens that way, or historically has happened that way. So that's when it's going to be harder to find those diamonds in the rough. So that's my prediction for what it's worth.
Yeah. No, I can't wait to do kind of a 2024 recap and see what came true. Because I agree with you. I'm on very much that kind of same sentiment that 2024 is going to be a really kind of, tough year with, a lot of, operators focus more kind of on inward operations while, debt and the kind of the pricing sort itself out. And the kind of the phrase now is survive till 2025, right? So kind of focus on operations for 2024, get your properties cash flowing, stabilize your debt, and then really kind of focus on, hey, now that 2025 is here and then we kind of have the operations kind of in check and we have the capital available to us. Now where do we kind of deploy, given kind of the frenzy that's going to be coming from the buying side for, those potential deals out there. I also think that the Midwest, I think, is going to see a lot of kind of focus as well, right? Like a lot of operators and syndicators that were kind of in that Southeast market that potentially got burned. They saw that the Midwest is kind of a very stable kind of sector that doesn't see the highs of highs, but doesn't see the lows of lows either. And I think that, is attractive to a lot of operators. I mean, I've even spoken with some. I said, hey, initially the East Coast all got built out, then it was the West Coast that got all built out, and the Southeast now is seeing its kind of revival. The last kind of untouched zone really is that Midwest sector that is kind of the industrial corridor for a lot of the country. So I think, hopefully we see a lot of growth in those areas too. Because we have, a couple of properties in Indianapolis, for example, that's seeing tremendous rent growth and very stable. And hopefully the same will be true for a lot of other Midwest markets as well. So, yeah, Robbie, yeah.
One thing I want to add, Nathan, to that is the other place I see opportunity is the greenhouse gas reduction fund. There's a ton of opportunity in renewables. I'm super excited about this. This is a big passion of mine, and we're looking at putting solar on multiple properties of ours. In fact, one property we have, we're going to put solar on the roof at no cost to us, which is pretty amazing. Somebody reached out to me about that, and I'm happy to talk to any of you about that if you want to reach out and find out more information on how we did it. But there's a lot of opportunity there, and not only are you going to be saving on resources, but you can generate a tremendous amount of income that way. So a win-win-win there.
Yeah, and we're noticing on the tenant front too. Like a lot of tenants and residents are actually asking and pay attention to, is their property green and kind of is there LED lighting, which also helps on the operational fronts. I mean, it's helping out tenants, it's helping out operators and the environment. To your point, Ravi, it's a win-win across the board.
Yeah.
Phenomenal. I appreciate your insights, Ravi. It's always good to kind of pull back the curtain, explore Vikings history, kind of find out how we're navigating the current market. I'm excited to do another kind of 2024 recap, see what predictions came true, which ones didn't, and see how we kind of navigate 2024.
Exactly.
Awesome. Thanks, Ravi.
Cool. All right. Thanks, Nathan.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.